FX Hub as usual. So basically I'm going to be taking us through the basics, the foundation of FX, and this course is basically tailored for beginners, starters, freshers, people that just came in new into the world of online trading, and to be precise, the forex market. So basically, I want to start off with a disclaimer. Trading foreign exchange markets on margin carries a high level of risk and is not suitable for all investors. Past performance is not indicative of future results. The high degree of leverage is dangerous and can work against you as well. Before deciding to invest in foreign exchange, you should carefully consider your investment goals, level of experience, risk tolerance. You will likely sustain a loss of some or all of your initial investments, and therefore you should not invest money that you cannot afford to lose. Do your research and talk to a professional financial planner to be aware of all the risks associated with foreign exchange trading, and seek advice from an independent advisor before risking any capital. Okay, everything shown on this tutorial or course is for educational purposes only and should not be taken as advice on how to invest in your capital. Always risk what you can afford to lose. Always speak with a professional financial planner or advisor before making any investment decisions. Never take a trade based on what you see in this video. I will not be held responsible for any losses that occur in your accounts. You and you alone are responsible for deciding if you are comfortable accepting the risk involved. So basically, in this Forex Foundation course, I'm going to be covering, for this first part, I'm going to be covering some aspects, and looking at your screen, and I've firstly highlighted them. So firstly, I've issued out my disclaimer, and secondly, we're going to be going through the definition of FX, and which is Forex. And thirdly, we'll move into the players on the foreign exchange market, and we'll see through what the Forex chart looks like, and what you can see in the Forex chart. Then we'll go through the base and the quoted currency, the bulls and the bears, and then the Forex brokers. Basically, this first part is for beginners. It's just basic for everyone. So let me start through with the definition of FX. Well, basically, I got this definition from Wikipedia. Wikipedia defines it as the foreign exchange market, FX, or currency market, is a global, decentralized, or over-the-counter market for the trading of currencies. This market determines foreign exchange rates for every currency. It includes all aspects of buying and selling and exchanging currencies at current or determined prices. So this is for Wikipedia. Basically, there is something about the evolution of money. It's everywhere online. There are so many things that led to one thing led to another, another led to another, another led to another. You could basically read more on the history of money and how we arrived at currently this very level. It's everywhere on the market, and it's quite a popular story. Well, without wasting much time, let me quickly delve through the evolution of money. We once had the trade by barter, which is quite popular or known by every history student, basically. Then we quickly graduated into the advent of gold. But before the advent of gold, the exchange of goods and commodity is what was quite popular, known as the exchange trade by barter, where you use a goods to exchange for another goods, or use one commodity to exchange to be exchanged for another commodity. Then we got into the advent of gold. That was during the discovery of gold. Gold was used in facilitating exchanges, between the exchanges of goods and services, nations and individuals. Then after that, we had the introduction of gold coins that portrays the value stored in the gold and validate the genuineness of real gold. After that, around the 18th century, paper money came into being, and after the paper money, we had the gold standard. At that point, currencies were backed by the gold reserve of their native countries. The gold standard became the first standardized means of exchange in history. Then after that, owing to some series of events in history, we still came around the Bretton Woods. That was quite popular then. That was 1944, became the gold standard 2.0. And after that, the gold standard, which was gold standard 2.0, referred to as the Bretton Woods, was actually the replacement of gold with the US dollar. And at that point, the US dollar had to be backed by gold at a fixed exchange rate of that $5 per ounce, while other currency had a fixed exchange rate to the dollar. Well, my business here is not to be reading out history for you, but it's just to lay some basic foundation. And after that, after the Bretton Woods agreements in 1971, Richard Nixon closed the gold window and that halted the Bretton Woods agreements. This in turn bettered the forex market that brought in diverse exchange rates to the world today. Well, without making much ado, because I'm trying my best to run through every basic thing here, let's quickly move into the players on the foreign exchange market. In the foreign exchange market, a lot of parties are involved. A lot of parties are involved. So we have the government, we have the central bank, the normal banks, the hedge fund. We have so many institutions involved. The speculators, which includes me and you, who's currently trying to learn understand the market. So it's quite popular, and it can be searched on using any search engine, maybe Google or whatsoever. It is claimed to have that the foreign exchange market has a daily turnover of around $6.6 trillion. Don't be excited about the amount of money you had. And quickly, let's move into Forex chart, which is what is actually on your screen now. That's just my business. We actually get into the business of the day. So in the Forex chart, let's quickly face the candlestick. So looking at my screen now, you may see a different candlestick. One is black, one is white. I'm still gonna get to the explanation of it all, but let me make some pictorial diagram, or maybe let me say pictorial representation of what I'm trying to explain now. Do this, and let me, sorry, let me, okay, let me clone this. Okay. Okay. Let me still put this here. Let me clone this. Clone again. Let me still clone this. Just trying to put this here, making it as simple as much as possible. Okay. Okay. Looking at my chart now, you may be seeing something there, but don't worry. I'm trying to draw something here. So let me leave this as black. Let me okay, make it black. Okay. Right. Black. Black. Okay. Just pay quite attention to what's on my screen. So this is me trying to put up this is what you see on your FX charts. So I'm trying to explain every concept you are looking at the screen now. So let me do this. This is close. This is open. This is low, and this is high. Okay, for this one, the same thing still applies. This is low. This is high. This is close, and this is the open. So is a bow, up, candle, this is a beer, down, candle. Okay, when you look at the chart, my chart now, you'll see something. I basically had two candles here. One is white, one is black. Actually, you are the person that will primarily choose the color of the candle you want. You choose the color of the candle you want. I do leave my candle as either white and black or green and red. White representing the bull candle, green representing the bull candle, black representing the bear candle, and red representing the bear candle. But on this chart, I have it as white and black. So basically, on every candle, you notice three things. On every candlestick, you notice three things. You notice an open, a high, a low, and close. Popularly referred to as OHLC. So every candle has an OHLC. So the O is for open, high, low, and close. These four concepts plays a very vital role when it comes to the understanding of market structure. If you don't actually get a good grasp on this basic concept, believe me, you'll find yourself finding it difficult to get across some concepts as you advance higher. So on a chart, you will notice a lot of things. You will notice a lot of lines, a lot of graphs, a lot of periods, but I'll do my best to try explain this concept. Let me go through the bull and the bear candle. So on this chart, my bull candle is represented as white, and on this chart, my bear candle is represented as black. So on a bull candle, the open is below and the close is above, meaning a bull candle opens below and closes above. And the low and the high is always the same, both for the bull and the bear candle. But for the bear candle, it opens above and closes below. So take note of these two differences. The open and the high is the same, but the the high and the low is the same, I mean, but the open and the close is inverse of each other. So you look at the screen, you take note of this very concept. So next thing on the chart, you notice the period separator. One is a daily period separator and the other one is for the weekly. Let me quickly throw up this is my MT5. You will notice the daily period separator and the weekly period separator. The moment you have two charts, two lines on the screen this way, what you have with you is the weekly period separator. This connotes 1 week. From this point to this point, this is another week. So this is a Monday, this is Tuesday, this is Wednesday, this is Thursday, and this is Friday. So this something applies Monday, Tuesday, Wednesday, Thursday, and this is Friday. So we are expecting the open of a new week. So this is Friday. This is the close of a week. This represents the close of a week. So this is the closing of a week. But since we're on the 4 hours time frame, the moment you see this period separator is the close of a day. This is the close of a day. This is the close of a day, and this is the close of a week. Now, when you're on the 4 hours time frame, this time frame here, it means it takes 4 hours for every candle to form. If you move it, okay, let's count the number of candles we have here. 1, 2, 3, 4, 5, 6. Now, in a day, we have 24 hours. 24 hours in a day. And when you divide this 4 by 24, but this 4 by 24, you're going to have 6. So in a day, when you're on the 4 hours time frame, you should be expecting a 6 hour, you should be expecting 6 candlesticks. Now, if you move down to the 1 hour time frame, now this is the 1 hour time frame. From here to here is a day. From here to here is another day. From here to here is another day. So from this connotes the start of a week, the end of a week, the start of a week, and so on. So if you move back, you notice a lot. The end of a week, the start of a week, through here, the end of a week, the start of a week, and so on. Now, when you're on the 1 hour time frame, it means it takes 1 hour for every candle to form, and on every candlestick you have so many information embedded on it. On every candlestick, you have so many informations embedded on it. Well, I'm not here to teach on time frame and on the understanding of certain concept on time frame analysis, but for now I'm only trying to take you through the basic, what you see on the FX chart. Now, after the period and time, you notice another thing. You notice price. We've spoken about the period. Let me move this to the 4 hours so I can have some things that are written, properly displayed on the chart. You have on this chart, you have some things. You have the period separator. So this is the daily period separator. I said this is the weekly period separator. And now let's quickly jump over to the next. We've spoken about bear and bull candlestick. When you see the white one, it means the market is going up, and when you see the black one, it means the market is coming down. Now you have various representation of a chart. A chart can be represented either as a candlestick, either as a bar chart, or either as a line chart. So take note of the difference. I'm currently on TradingView. If you move this thing now on TradingView, you have various representation of chart you can choose from. I can choose it to be a bar chart. So this is currently a bar chart. When you see the green one, it means the market is rising up, and when you see the red one, it means the market is going down. So this is a bar chart currently, and you on TradingView you usually have a line chart. So a line chart is just the representation of the closing prices of the day or the time frame you are seated on. So on MT5 you have various representation of various time frames and whatsoever. And on MT5 you can choose how you want your chart to be displayed, either as a bar chart, either as a line chart, or either as a candlestick chart. So this is a candlestick chart now, this is a line chart, and this is a bar chart. So I believe you've seen it, you've seen the difference. And quickly let me jump back to TradingView. So this is trading view. Let me quickly move this thing to a bar chart. Basically this concept now we're trying to do move as much as fast as we can, so we can quickly jump into the next concept. Now on the time frame, you notice various things. You notice time and price. Time and price. If you move your cursor, this is my cursor now, to every price or to every candlestick, you always discover something. You will discover on this axis you will see the price, and on this axis you will see the time. So let me quickly drop it on any candle. Now you see on the 16th of March being 2022, when the time is 4 p.m., the price of the Great British Pounds to a dollar is 1.30439. Are you getting it? So it means for you to get 1 Great British Pounds, you have to have $1.30439 in place as at 16th of March 2022. Now let me move it to maybe to another candlestick. Let me say this one here. So on the 4th of March 2022, watch the information I'm reading here. If you look at this chart now, on the 4th of March 2022, this axis here now is the time, and this axis here now is the price. Please take note. This axis is the price, and this axis is the time. So let me move it to any candlestick. So on the 4th of March 2022, you can see the time close to it. The price of 1 Great British Pounds to a dollar is $1.32239. Are you getting it? As simple as that. As simple as that. So let me quickly move to another thing you will notice on your chart. Now there are various charting tools you can get on TradingView, and likewise on MetaTrader 4, MetaTrader 5, CTrader. I'm not going through to revise various trading platforms, but I've just mentioned the popular one. Well, the candlestick and bar chart have more information than the line chart. Yeah. For me, I prefer using the candlestick chart. The candlestick chart has enough it has enough information. Likewise the bar chart, but on the line chart you only get the closing price of closing price of the day or the time frame or the range in which you are currently situated on. So but everything still boils down to personal preference. But let me quickly run down to one of the last concepts you should take note of when you are looking at the trading platform. This is your trading platform. The last concept you have to take note of when looking at the trading platform is you have to take note of the base and the quoted currency. So the base and the quoted currency, let me just write out something here. Okay, let me say Euro USD. Let me say USD JPY. Let me say something like GBP JPY. Let me say something like USD ZAR, and let me also AUD CAD. So now you take a look at this. Let me pick out, maybe let me write out something else here. GBP JPY, and let me try separate it. Okay, the base and the quoted currency. Okay, let me write out something again. GBP USD. I make a space between the both of them. So this is it. Okay. Let me still increase the space between them. Okay. So, okay, this is nice. Now, looking at those now, the base and the quoted currency. Always take note, the base currency is that by the left and the quoted currency is that by the right. Now, on this example here, I've listed out some pairs: Euro USD, USD JPY, GBP JPY, USD ZAR, and AUD card. So Aussie card. So that's AUD card. So let me this on these now. The base currency is that by the left, is the pair by the right left, which is Euro. The pairs on the left here are the pair on the left here is Euro, USD, which is US dollar, GBP, which is Great British Pounds, USD again, and AUD. So it means on these pairs now, the base currency are the Euro, the USD, the GBP, the USD again, and the AUD. And the quoted is that by the right. The quoted here is the USD, the JPY, the JPY again, the ZAR, which is South African Rand, and the card. Now let me quickly use this two pair to these pairs to explain this concept: the base and the quoted currency. This is the base currency and this is the quoted currency. This is the base currency and this is the quoted currency. What does it mean? The base currency, please, you need to pay a very close attention to this. The chart, the base currency, the chart express the value of the base currency. Let me please explain that to you. The chart expresses the value of the base currency in the price of the quoted currency. Now currently we're on GBP USD. Can you get me? Currently we're on GBP USD. It means that, okay, as at, let me just move my cursor to anywhere. As at, please look at this very point. Look at this very point so you can get what I'm trying to say. As at 4th of March 2022, as 4th of March 2022, when the time was 4 a.m. in the morning. Now, please look at this very point. Now, let's get the price. As at 4th of March 2022, when the time was 4 a.m. in the morning, the price of 1 GBP, Great British Pounds, to a dollar is $1.33247. So let me add that here now. Okay, let me add that here. Okay, $1, let me get it, $1.33260. $1, 4 p.m. okay, 3327. okay, 33240. Let me just go with that. 33240. Okay, so as at when it was around this time, it means GBP USD, it means for you to get 1 Great British Pounds, you need to have $1.33240. Now let's quickly jump into another pair now. Let me say what's the pair behind. This is GBP JPY, and let me just put my chart, my cursor here. As at 10th of March 2022, you need to have 152.049. Let me 152.049, and then let me move it this way. GBP JPY. Okay. As at 10th of March 2022, you need to have 152 yen to get 1 pound. So when you look at the chart here, the chart expresses the price of the quoted relative to that of the base. So for you to get one of these base currency, you need to have so and so value that is being displayed or indicated on the right. That's what we said earlier. The chart expresses the value of the base currency in the price of the quoted currency. So let's quickly jump to another pair again. We are currently on Euro GBP, Euro pounds. If I place my cursor on this price here now, it means as at 8th of March 2022, I need to have 0.82967. I need to have to get €1, you need 0.82967 pounds. Are you getting it? Now, so on the left is euro, on the right is pounds. But for me to get €1, I should look at the price of what I'm having by the right. Now, if you jump to GBP, this GBP card, for example, and I place my cursor here, it means as of 10th of March 2022, for me to get 1 GBP, which is the base currency, I need to have 1.68334 Canadian dollars. I hope this is getting clear. So currently, we have major pairs and we have minor pairs. Let me quickly type out all the major pairs you'll be trading in Forex. We'll have the Euro, USD, we'll have the USD JPY, we'll have the GBP USD, we'll have the USD CHF, we'll have the USD card, we'll have AUD USD, and we'll have NZD USD. So 1, 2, 3, 4, 5, 6, 7. These are the 7 major pairs you're gonna come across in the foreign exchange market. So the rest, then you will have what is known as the cross pairs. Now these are pairs that do not contain the US dollar as either the base or quoted currency. And the foreign exchange market, okay, let me put up some other pair here. When you see something like Euro GBP, Euro JPY, GBP JPY, and you have something like AUD card. So these are not the only ones, but they are the first one. Okay, let me do something here. These are major pairs. Okay. Okay. These are major pairs. I mean it. Okay. These are referred to as cross pairs. So the cross pairs, they do not contain US dollar as either the base or the quoted currency. Remember the last time we spoke about the bulls and the bears? Well, we said the bulls they invest in the growth of a currency pair by profiting from the rise, and the bears, they profit from selling the pair. And we said something about the bull candle on the candlestick chart. That the bull candle, it opens close to the low and closes around the high, and the bear candle opens around the high and closes somewhere around the low. Now these two names, whether the bulls or the bears, it does not, either of them does not connote pessimism or optimism. Every trader goal is to profit regardless of the direction of his or her position. Now, the mechanism behind the profit for a bull is to buy low and close high. The mechanism behind the profit for a bear is to sell high and close low. So, now, in the Forex market, you are off a position when you close it. Whether it doesn't matter whether you are buying or you are selling. Again, this is a continuation on the Forex Foundation course, and we're going to center more on FX brokers and FX market hours, FX, which is Forex. So basically, according to Investopedia, it said, who is a broker? A Forex broker is a financial service company that provides traders access to a platform for buying and selling foreign currencies. Well, there are types of brokers. There are market maker broker, there are ECM broker, and there are STP broker. Well, however, make your research on types of brokers. I'm not here to give you a review on brokers for now. There are reliable and unreliable brokers. Some brokers will trade against you and make you lose money effortlessly. That is why we got to be very selective when selecting a broker. If there are certain features you want from a broker, you watch out for it first before adding funds to a broker. So we're going to be moving next to the next concept, which is FX market hours. So in FX, there are actually, should I say, sessions. It's known as trading sessions. The Forex market is broken up into 4 major trading sessions. The Sydney session. Let me type that here. The Sydney. Okay, let me take this down. Sydney, London, New York. Oh, what is this? New York and Asia session. Okay. So these are the 4 major trading sessions you're gonna come across. Sydney, London, New York, and Asian session. Well, it is considered best practice to trade certain currency pairs in or during their trade sessions. Yeah, so I will put up an image now on the screen that will really help us to look through this for this trading session. Okay, so on my screen now is trading sessions. You can see Sydney opens, you see Sydney close, you can see Tokyo open, Tokyo close. Here you can see London open, London close, and here you can see New York open, New York close. And you also notice this EST, Eastern Standard, Eastern means Eastern Time, and these UTC means Coordinated Universal Times. So you can take a look at that and do more research on it yourself. Take for example, I'm mostly concerned during the London and the New York session. UTC +1, that's my time here in Africa. It opens around 8 a.m. and closes around 5 p.m. And for the New York session opens around 2 p.m. and closes around 10 p.m. That's for UTC +1. So, but if you go with this UTC as it is here now, you can actually do the change or conversion to your local time, and you see when it's open and when it closes. So basically, I prefer the London and the New York session. The London and the New York session. It tells me, it's actually open when I'm awake. So I trade what I feel that I am more active. I'm more active during this period, during this very session. So that's why I'm more concerned with trading them. Also take note that there is also a session where there's always a point when session, should I say, 2 sessions are open at the same time. So we'll call it session overlapping. And one of the favorite session overlapping you'll come across is London and New York. So I'm looking at this time, you see that so many of the sessions overlap, but it's very nice when the London open overlaps with the Tokyo close. You can see it's a very nice time to trade, and also when the New York open overlaps with the London close. So when you see 2 sessions open the same time, or maybe 2 sessions are actually being open or overlapping, it's very nice, because during these very points, naturally, these are the busiest times during the day, because there's more volume coming into the market, money's changing hands, more increased participants. So a lot means money being transferred, buying and selling. So volume is up. So this is just one of the favorite time you like to have your orders executed, because orders are entering the table and coming into the FX. When I say table, it doesn't mean physical table. So all orders are coming into the market, and orders are being executed at the speed of light. So a lot of buying and selling, liquidity, very nice, excellent. So these are just some of the basic concepts, and I just want you to actually, of everything I've said, please still look at this very time and actually make a mental note of it, and do the conversion into your local time, because it's going to really help you. And there are apps you can get on Google Play Store, Apple Store, maybe even on normal search on using Google. So there are some apps that actually help you to actually know which trading session is on and which is off. So you can use all those stuffs. They really help to simplify stuff for you, even as a beginner. So that's all for now. Thank you.